Welcome everyone to Daniel Krug and Associates Wealth Management Review for February 18th, 2021. Today's presentation is titled Shifting Tax Landscape, Preparing for 2021 and Beyond. My name is Rocky Ispan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel M. Krug, CEO and Senior Wealth Manager, will be joining me in just a couple of minutes here. Just a reminder that this presentation is for informational and illustrative purposes only. It is not a solicitation and should not be considered investment or tax advice. We believe this information to be from sources that are reliable, but we cannot guarantee its accuracy and is subject to change over time. If you have any questions regarding your taxes, please contact your CPA or tax advisor to get those personal decisions made for you. Today, just a reminder that the duration is going to be about 45 minutes, and we will save time for some general questions at the end. Again, we don't want to get specific tax questions because we are not CPAs, but we will handle any general questions. This session is recorded. We will make this available for future viewing. Everyone is muted, and please use the chat room if you have a question, and we will get to those at the end. Just a reminder what wealth management means to us at Daniel Krug and Associates. It all encompasses and is built around your investment strategy. That is very, very important and the foundation for what you're trying to do to grow your wealth. But we've found over time that the enhanced advanced planning strategies that we bring to the table and makes such a huge difference over the long-term growth of your wealth. And those areas are in wealth enhancement, wealth transfer, wealth protection, and charitable giving. And you can see all the subcategories under there where we get into tax mitigation, legacy planning, critical illness planning, and charitable giving. So lots of things go on that can really grow your net worth over your lifetime, in addition to just having a sound investment plan. And now what I'd like to do is bring Dan and myself on the screen here to say good morning to everyone. So Dan,
morning.
Welcome.
Yeah, thank you. So we've got a lot of information today. It's going to be an interesting one. Some serious changes are coming down the road, it would appear. But what we're going to talk about really is a little bit about where we are from a debt standpoint for a country, and then ultimately, how is that going to affect us moving forward? In the middle, we're going to really talk about 2020 tax returns. So what do we need to do to prepare for your 2020 tax returns? I know many of our clients have already got their tax returns in and done. So kudos to them, but for those that aren't there yet, we're going to walk through some of the specifics of 2020 so you can get a good handle on what needs to be put together and what you can look for the returns for 2020. So
let's get started.
Yep.
Here we go. Just a recap of the agenda for today. We're going to start off talking a little bit about the national debt and will it affect your taxes. Then we're going to go into preparing for your 2020 tax filing. Like Dan said, many of you have got it done, but just some reminders of things to do if you don't have it done. We're going to cover 2021 tax planning, and then we've got City National Rockdale's kind of future tax outlook. So we've gleaned some things from them that Dan is going to go through in a little while, and then what to do if you have any further questions at the end. So I'm going to turn it over to Dan to get us kicked off on national debt.
All righty, national debt, something that everybody wants to talk about, right? Well, let's go back historically. We're going to go back really 6 presidencies to what the debt has looked like over time. This graph actually runs back before and during, I guess you would say, World War II, where you see there was a beginning spike in the national debt. And keep in mind that this graph is really talking about debt held by the public as a percent of the gross domestic product or the GDP. So in this, you can see from World War II moving all the way to Carter, the debt continually moved down, and we had some reasonably high tax rates at that point as well. Carter came into effect. He continued the move with the debt going down. Now that was the plus side on Carter. The negative side, if you wanted to get a mortgage, you were going to be paying double digits to get there. Can you imagine if we had the debt that we have today with the interest rates back then? That would probably have bankrupted our country. But that wasn't the case. Reagan came in, really applied Reaganomics to try to get the economy kicking at that point. And the administration did a very good job of getting the economy moving. But it did acquire more debt as it went along. And same happened in the Bush era, the first Bush senior. So it kept moving up. Now, when Clinton came into the presidency, at that point, he was really inheriting a pretty good economy, let the programs ride a bit. And you could see he also had the ability to move the debt down lower. So that worked out pretty well all the way to about 2000. You see, G.W. Bush took office, and as you recall, that's when we had the crisis, the financial crisis, where we had the dot-com bubble that burst with the stock market. We had a little bit of stimulus that went back into the economy, so you could see there's a little bit of bump up in his presidency. And towards the end of his presidency, then we ended up in that financial crisis with the bubble on the housing market and everything that went along with that. Market crashed again at that point, and Obama took over right at the end of that and really towards the beginning of the recovery. So when you look at it from once G.W. Bush got out of office, Obama took over, there was a sizable increase because there was a lot of stimulus going on at that point. You get to the end of Obama's period and Trump takes over. Well, it's interesting with this one because during his tenure for the first 3 years, the debt actually stabilized at that point. And a lot of that was due to the fact that there were so many people employed that it was bringing in a lot of taxes. So it was helping the situation at that point, although it did go up a little bit. Now, then COVID hit, and we started really pushing the stimulus packages. And towards the end, the last year, 2020, we racked up some serious debt to try to keep the economy moving and keep people solvent throughout that period. So now we're in a different era. The projections that they're looking at right now is that the debt is going to continue to go up. That's kind of worrisome for us, but one might ask, well, okay, the debt's going up. What are we going to do about it? Well, we'll talk a little bit about that. The first part, though, is where is the debt? Well, I want to thank Peter G. Peterson Foundation because they've got a national debt clock, and we kind of copied the numbers down where we are today. And we're reaching very close to $28 trillion worth of debt, which is about $84,000 per individual in America. Pretty big numbers. So we're talking about men, women, children type thing. So it's a lot of money that we owe per person if we want to get out of debt. And the only way to take care of that is either growing the economy or a combination of growing the economy and taxing, kind of Reaganomics 101. So let's move forward. What's causing the debt? Well, when you think about the changing demographics, the projected senior population, and that's 65 years and older, is growing substantially. You know, from 2010 to 2020, it jumped 16 million. And you move forward another 10 years, it goes from 56 million to 73. That's a big jump, and it doesn't look like it's stopping either. So we do have an aging population, and with the aging population comes expenses. One of the biggest expenses is going to be the rising healthcare cost. If you think about it, in many ways, the healthcare is the most important issue for the national's fiscal and economic future. It really does represent about 1/5 of the entire economy. So it's a big number. So if you look forward and you think about the costs, this graph here shows the healthcare cost around the world and where we are. So you look at the United States, our healthcare system's the most expensive in the world. Now, that being said, it is also the best in the world. So when you look at it, if you want a Cadillac, you got to pay the price for the Cadillac. If you want a Chevy Chevette, you pay the price for a Chevy Chevette. But somehow this cost does need to get under control. Unfortunately, there's really no consensus on how to do it at this point. So what they're projecting is that the healthcare costs are just going to continue to move up. Now, you think about the debt and revenues, where we are today. The fact is we've got inadequate revenues coming in to cover the growing debt. If you think about it, you've got revenues and you've got expenses. If the expenses are over the revenues, what's going to happen? Your debt's going to go bigger, right? So it's important that we get some kind of balance going on here. So why is the national debt so high? Well, the reality is when you look at the revenues from 2019 and the total spending, we got about $1 trillion deficit there. That's a big number, and that's one of the reasons the debt continues to go up. So we've got to control the revenues as well as the spending. You know, it's no different than a household at home. If you're making $100,000 a year, but you're spending 110, well, at some point you're going to reach a tipping point, and there's going to be a problem. You're going to have to cut back big time, and that's kind of where we are right now with the U.S. spending. Now, we talked about Medicare being really the second fastest growing, but the area that is the biggest concern right now is the interest on the debt when you're looking forward. Because if you think about it, actually, if you go back about 5 years, this is an interesting fact. I was thinking about this earlier. If you go back about 5 years, the interest on the debt was actually about $500 billion. So it was actually higher from a dollar standpoint. Now you might say, well, if the debt's gone up, why is the interest going down? Well, what happened to interest rates? 5 years ago, interest rates were a lot higher than they are today. So the cost to carry that debt load is less, but it's continually growing. So again, if you could imagine, if the interest rates go up, if they double, what happens to the debt load? It doubles also, right? But what they're projecting based on the debt not curving is that the interest on the debt is really projected to actually more than double. So it is the fastest rising cost in our spending for the United States at this point. So the debt does have to get paid down. The interesting thing when you're talking about all this money that's being spent, and we didn't even talk about the fact that we just had another $1.9 trillion spending with the COVID relief, and how is that going to play into this whole thing?
That's still coming. Yeah, it's interesting. Those are mind-boggling numbers to me.
Yes,
I mean, when you're talking 27 trillion, and then you associate it with the annual budget revenue chart that you just showed of only 4.45 billion, that's annually.
Yeah.
How many years of debt does it take to accumulate that 27 trillion?
Well, we know how fast we can accumulate it, and that's an easy one, right? It's easy to borrow money. It's paying down the debt that's a slow and painful thing, and that's really what you're saying, right?
The only positive of this is that the government turns out to be a bigger spender than me. So now I don't feel like that when I have to buy something. So.
Yeah, that's right. That's right.
Anyways, so what we're going to do is continue on here. We're going to move on to the next step. And I'm going to go over the preparing for your filing your 2020 taxes. And most of you, like we said, has probably done that or almost have it completed. But we're just going to do a short recap here on your tax filing for 2020. So first of all, here's the brackets. So again, these were changed with the Trump tax cuts. The 10% tax bracket was introduced. So that put low income people in a lower tax bracket. So that was a good thing. But you can see that we now have basically 7 levels of tax brackets down the left side, starting at 10% all the way up to 37%. And what's interesting is when you look at these brackets, you notice there's a couple of spots where there's a big jump. There's a big jump going from the 12% bracket to the 22% bracket. And that jump takes place for a single person at $40,125 of annual adjusted gross income. And for a married couple filing jointly, that's $80,250. Everything above that now jumps from 12% taxable to 22%. And then the next big tax jump I see is from 24% to 32%. So a single person making over $163,000 a year will pay an additional 32% on every dollar over that, just like a married couple filing jointly starting at $326,600. And it goes all the way up to 37%. And so what I did is I did a little calculation just to kind of see, because there's tax brackets, and then there's your net effective tax rate. And how do we calculate that? And I'm going to keep it simple by staying on the single side of this equation on the brackets. And let's say a single person makes $100,000 a year after adjustments. So their AGI, adjusted gross income, is $100,000. That means on the first $9,875, they're going to pay 10%. On the next $30,000, that 12% bracket, they're going to pay 12%. The next $45,000, they're going to pay 22%. And that final $15,000 falls into that 24% bracket because $100,000 falls between 85 and 163. Okay, so you see that? Now, when you add up 10% of the first bracket, 12% of the second, 22% of the third, and 24% of the fourth, a single person making $100,000 a year is going to pay about $18,079 in federal taxes with an effective rate of about 18%. So that's the blended rate. So that's how your taxes are calculated, and we wanted to point that out to you on this chart. Moving forward, we're going to talk a little bit about standard deductions. Standard deductions also changed significantly with the Trump tax cuts. We used to have a personal exemption and a standard deduction. The personal exemption, as you can see at the bottom, has gone away. There is no more personal exemption. However, the standard deductions were increased significantly. If you look at a single person back in 2018, their deduction was $12,000. It's increased $200 a year, up to this year being $12,400. A married couple filing jointly in 2018 started at $24,000 for their standard deduction, and that grew by $400 a year. And in 2020, your standard deduction is $24,800. So let's talk a little bit about itemizing deductions and things you need to gather putting your taxes together. It's very important that you have and keep these records, because these are backup records to your tax return. Your pay stubs, any mortgage payment records, if you bought a home, your closing paperwork, receipts for items or services that you may want to be able to claim as a deduction. Again, get with your CPA or your tax preparer. They will help you with which of those deductions you qualify for. And your records on charity giving and donations. Let's keep moving forward. Mileage logs on cars used for business, business travel receipts, credit card and bank statements to verify those deductions, medical bills, your 1099 forms for state and local taxes you get to deduct. And you have to claim dividend and other income off of 1099s. So all that gets included in the things you need to gather and put together. Also remember that the IRS has revamped the way itemized deductions can be claimed on Schedule A. You get that personal deduction if you're single of $12,400 or married filing jointly of $24,800. But if you feel that you can go above that, and for every dollar above that, you get to claim on your itemized deduction. So that's where your CPA or tax preparer will do the calculation for you and tell you, do you qualify for Schedule A or just the standard deduction? So we got to remember that changed quite a bit a few years ago. So what all other changes have taken place is the itemized deductions are not limited if your adjusted gross income exceeds a certain amount. There used to be a cap on it. There's not a cap anymore. The second point is job-related and other miscellaneous expenses can no longer be deducted. Third point, certain other expenses such as gambling losses can still be deducted just in time for gambling being legalized online in Michigan, and you're starting to see all kinds of ads for that. And the final point here is the cash charity contribution limit is 60% of your AGI. So if you're giving big to one organization or multiple organizations, you're giving cash donations, you're limited based off of your AGI at 60%. Also, you may no longer deduct moving expenses unless you are an active military person. So that was a big change too that has taken place. The child tax credit remains at $2,000. This did not increase. However, they did add the ability for you to get an additional tax credit. The $1,400 applies when taxpayers are unable to fully use the $2,000 non-refundable tax credit to offset their taxes. So there is a way to get a little bit more there, even using the standard deduction. And then the credits phase out at income thresholds of $200,000 single or $4,000 married filing jointly. So you don't get any child credit if you're above those thresholds. Just a reminder on what the 401k contribution limits were for 2020. Employees could contribute up to $19,500 to their 401k plan. Anyone age of 50 or over was eligible to add a catch-up contribution in addition to the $19,500 of $6,500. And in total, if an employer was matching or contributing to your 401k, the limit for total contributions is $57,000 or catch-up of $63,500 for last year. On IRAs, a little different situation on the IRA contribution limits. On IRAs, your limit was $6,000 per person, $7,000 if you're age 50 and older. So that was unchanged from 2019. The Roth IRA contributions limits are reduced or eliminated at higher incomes. So, and again, this is a combined contribution, Roth or IRA. You're limited to the $6,000 total. Traditional IRAs are deductible, but the amount you can deduct may be reduced or eliminated if you or your spouse is covered by a retirement plan at work. So you have to take into consideration, are you already in a 401k plan? And then there is a lower income taxpayer may be eligible for the saver's credit if they contribute to an IRA. And again, your tax preparer or CPA will help you if you qualify for that. So one other thing to do is take a look at your last year's tax return and look to see if there's any opportunities. Take one more look, because you actually can still contribute to your 2020 IRA through April 15th of this year. That did not end in December of 2020. So that could lower the amount of tax you have to pay this year. So you need to take a look at that before you make your final filing. Also, we're going to throw an idea here. So for people, because the deductions have increased so much, many people do not qualify anymore for itemized deductions because their interest on their mortgage, their property taxes and stuff are low, and your personal deduction of $24,000 for a married couple, you might not reach that number. However, think about bunching your charitable contributions. And what this basically says is if you give X amount of dollars to an organization, look at pulling next year's contribution into this year and doubling it, which may then qualify you for itemizing this year. And then next year, taking the standard as opposed to taking the standard in both years. Again, talk to your CPA and ask about that. Should I pull ahead some deductions? And would that make sense for me over a 2-year period? So capital losses, just a reminder that if you have losses in the market, that you can claim those. They have to be in excess of your capital gains, so you have to do the offset. And the maximum you can claim in the year is $3,000 if you're married filing jointly, or $1,500 if you are filing separate returns. Just a reminder too, though, let's say you had a $30,000 net loss in 2020. You would be allowed to take $3,000 of that $30,000 every year over the next 10 years. So that's how you can apply it in future years. But you're limited to just the $3,000 in the current year. Some important dates, we're already past January 15th. So if you were self-employed, you should have paid your final fourth quarterly estimated taxes by January 15th of this year. The next key dates are April 15th. A few things happening on that date. Your return is due, or your extension. If you're filing an extension, that extension must be filed, and your proposed tax also needs to be filed at that time, even though you're not going to do your final return because you're filing an extension. And also on April 15th of this year, your first quarter estimated tax payment is due. So a lot of taxes due on that day. And it's also the last day you can make a contribution to your IRA or Roth IRA. And you need to note that when you turn that into your investment advisor, that you want that credited to 2020. That has to be noted so the financial institution knows how to apply that investment. Upcoming in June, your second quarter estimated tax payments are due June 15th. September 15th is the third quarter estimated tax payment due. And then October 15th is the extended individual tax returns are due. So if you filed an extension, this is your final day, October 15th, 2021, to get in your 2020 tax return. I know I covered a lot of stuff there.
Yeah, taxes.
Isn't this fun?
Yeah, if you are working with our CPAs, whether it be Brenda Hunter CPA or whether it's Guy Cagle, they have a form that they send out to their existing clients that gives you a list of everything that you want to be looking at for your tax returns. So take advantage of that. It just helps you check off the boxes to make sure you've got everything taken care of the way you need to. And it works. I mean, it helps. I was looking through their form 2 days ago, getting all my tax stuff together. And there was a couple items on there I forgot about, and it helped me remember. So it's helpful. If you need a copy of it, we have copies, or you can get them directly from your CPA because they do have them. And again, if you are already a CPA or you're already a client of that specific CPA, they will send you or already have sent you out that document. So
why don't you take us through 2021 tax rates?
All righty. So we're going to look briefly at 2021's tax rates. And then what we're going to do is we're going to talk a little bit about where CNR is thinking we're going from a tax standpoint. And they do a lot of study. They put their fingers in the air, try to figure out which way the wind is blowing relative to all the policies that they're touting out there. And this is kind of what they came up with so far. First, let's talk about the tax rates. As you can see, there's not much change between 2020 and 2021. For example, a single individual at the 10% bracket their bracket went from a cap of 98.75 to 99.50. And on the married side, it jumped $150 to $19,900. So it kind of worked like that all the way through. So we've got another year of some pretty decent tax brackets to do planning, because at the end of the day, it does look like we're starting to run out of time here to get the planning done to make sure that we don't get absolutely rocked by what appears to be coming down the road from a tax policy standpoint. If you look at the standard deductions, Rocky talked about what they were for 2020. In 2021, they're increasing again. A married couple filing separately or single individual, theirs is going to go up by $150 to $12,550. If you're a married couple filing jointly, the deductions increase $300 to $25,100. So again, that just keeps the taxable income down for you. So between the current brackets and the current standard deductions, this is really going to be one of our best years as taxpayers to be able to strategize and get ourselves in a better position moving forward. At this point, like I said, 2021, it does present opportunities. We really have to be looking at our long-term tax mitigation strategies and seeing whether it makes sense to double down this year or just increase the percentage of dollars that we're converting so we are in a much better position moving forward. Now, let's talk about CNR's take on the tax proposals. And what I'm going to do is I'm really going to talk about the different areas that look like there is a high propensity of change coming down the road here. So one, when you think about the Tax Cuts and Jobs Act, again, this was something that was put together during the Trump administration, and it was a big part of the Democrats' platform moving forward. And they are, if you think about it, the thought is we need to pay more taxes to get the debt down. And I get that. I really do. We can't keep spending like we are and expect this debt to go away. It's going to have to be paid for. We all know that. We all know it's coming. Now, right at this point, the Tax Cut and Jobs Act is scheduled to sunset or expire for most of the provisions in 2025. That's already on the books. Now, the question is whether the Tax Cut and Jobs Act will survive until the end of 2025. And by all accounts, from what is being said, the posturing and really the direction that City National Rockdale thinks this is going to go, they're not too confident that it's even going to make it that far. So what we're talking about is increased taxes coming a little bit sooner. Again, that's why 2021 is so important to positioning yourself for the future in the best tax situation possible, and that's tax mitigation again. So one of the proposals, if they do get rid of the tax cuts that we got through Trump, it's going to look like this. So on the left side of this page, you got the current tax rates. Okay, Rocky's already talked about them. I've already talked about them. If you move over to the right side of the page, it's the Democratic proposal, which again goes back to the old tax rates that we had. So there's a significant change. The three brackets that get hit the most, 12%, 22%, and the 24% brackets are going to increase the most. Kind of the heart of the middle class right there. And when you look at the center chart, it shows you the tax increase as a percentage. So think of it this way. If you were at the 12% bracket and the proposal says that we're going to go to 15, well, that's a 3% increase, and 3% is 25% of the 12% Tax Cut and Jobs Act rate. So you can see at 12%, it's going to go up 25. At 22% bracket, it's going to go up over 13. 24, it's going to go up over 16, and so on. So there is a significant increase there. And if our clients think back to the year after the Tax Cut Act went into effect, the average clients of ours were literally saving between $2,000 and $5,000 in taxes during that first year. And obviously the second and third year happened the same way. So when it turns back, just to get the mindset straight on what will happen if we go back to the old rates, you can expect to pay between $2,000 and $5,000 more in taxes. So it just gives you a little bit of perspective as to how much we're going to end up paying. Now, again, I have no problem with higher taxes as long as we're actually going to pay down the debt. If we continue to spend and don't pay down the debt, all we're doing is paying more taxes. So do you have a plan? And with our firm, it's always about planning. If you have a plan and you execute it, you make the adjustments along the way, you're going to be much better off in the future. If you don't have a plan and you just kind of go on the way the wind blows, it's going to get a little bit topsy-turvy on you. So planning is always the key for this. Let's look at the impact of recalling the Tax Cut Jobs Act. What would that have on the effects of the individual taxpayers' returns? Well, okay, we've seen this chart. Now you got it memorized. Let's move on to the next slide. So what this slide is showing you is a calculation of an individual, and I'm going to show you three different wages, three different incomes, and how the current tax rates fare against the proposed tax law. Again, this is all about understanding what's coming so we can make good, sound decisions from a planning standpoint. So under the current law, if you have income of $65,000, your effective tax rate, Rocky talked about the net effective tax rate, would be about 10.3%, and you'd owe about $3,891. Well, under the new tax laws, your taxes would go up about $794, or in this case, about a 20% increase in the dollars that you're actually paying out in taxes. Well, you might look at that and say, well, that's not too bad. We could deal with that. Well, let's go on to the next income level at $150,000. So if you're at $150,000, the tax difference between the current rates and the proposed tax rates is about almost $5,900. Well, that's a little bit bigger number right there. And it also represents a 33% increase in the dollars that you're giving in taxes. All right, well, let's go on to the next person. What about an individual who's got income of a little over $477,000? Again, married filing joint. Well, under the current tax laws, we're at a 20.3 net effective tax rate. Under the proposed laws, it goes to 23.6. In this case, they're paying almost $14,000 more, or almost 16% more in dollars paid out in taxes. So it's not a small change when you're talking about going back to the past relative to these tax laws. So what we want to do is we want to be able to anticipate, make sound decisions on the way the policies are moving so we don't get caught with our pants down, right? We want to make sure that we're doing the best we can fiscally to make sure that we keep as much as we can in your pockets from a tax standpoint. So again, do you have a plan? That's just going to be the common thing through this whole presentation here. And planning is everything. Now, let's talk about the capital gains, because there's talk about changing capital gains. Well, our current capital gains rate is based on the income bracket that you're at. If you're at the 10% level, well, pretty much no taxes on the capital gains. Same thing with your 12%. Well, that really helps the little guy, right? Because it allows them to ultimately keep more and make ends meet. You get into the 22 through 32% bracket, now you're at the 15% rate. And then when you get to the higher levels, 35 and 37%, you're going to have a 20% capital gains rate. Now, I do need to note here that on income above 441,000, you're also going to get an additional Medicare tax, which is the 3.8%. So that's for income levels over 441. That's where we are today. Now, let's look forward a little bit. If our capital gains rates are sitting here, 23.8 maximum at 441.5 or better, where are we going? Well, the proposed capital gains rates are a little bit vague at this point. We're not really sure how this is all going to shape up. Now, if it shapes up the way they're talking today, well, the new proposal would eliminate the favorable 20% tax rate on people who are making more than $1 million. We're really not clear on anybody below that. But in this case, if you make $1 million, which most people would say, well, that's a lot of money. Well, there's going to be a lot of tax paid on it as well, because you've got 39.6% at the ordinary tax rate, your bracket, plus an additional 3.8%. If you're in the state of Michigan, you add another 4.25%, and you're closely approaching 50% of that money going away to taxes. A lot of money. So that's a big deal right there. Now, let's move forward to the stepped up basis. Maybe you've heard in the news about the fact that they were trying to put the stepped up basis in effect almost immediately. Matter of fact, they were actually putting it in, well, it was in there at one time. It was in the proposals for the COVID relief, this last package that went through. But I think someone figured out that COVID relief plus making someone pay more taxes didn't quite sell very well to the public. So they got that out of there. But I would not expect this to go away. The stepped up basis under the current law provides the full stepped up basis at death. So that's a good thing. That works on everything but retirement type assets. Now, if you go to the proposal says that they would just repeal the stepped up basis altogether. Now, what's not clear is that if you have an estate that falls under the death tax, or your estate is high enough to where they're going to charge a death tax to you, what's not clear is, are you going to get hit with capital gains as well as the death tax? Now, those would be some real big numbers, Rocky, at that point. And that's transitional debt or transitional estates. That's taking your wealth and trying to transfer it to you, but it being sidetracked over to the government. And again, if the government knocks the debt down, we get in good shape from a debt standpoint. I think, you know what, we just got to grin and bear it, right? We got to pull up our bootstraps and do it. But we've got to control the spending at the same time. So let's move to corporate tax rates, because the corporate taxes are looking to go up as well. And I will tell you this is going to affect employees from a business standpoint. So on the corporate tax rate side, the proposal really is to raise the corporate income tax from 21% up to 28%. Now, how does that affect a corporation? Well, some people look at these numbers and say, well, these big corporations should pay more taxes, like the Amazons and the Netflix and such. But this tax rate doesn't just apply to them. It applies to small business owners. It applies to your restaurant down the street. That knick-knack shop down the street that you frequent. It applies to them as well. So it's not just a big business corporate tax. It's any business, large or small, that is paying taxes, that is a corporation. So if you look at this chart here, think of a small business owner. Let's say they have a net profit of $200,000. Well, the additional tax on that profit is 7% or an additional $14,000. Well, okay, the business might be able to absorb that. I mean, $14,000, the owner just gets paid less, right? Well, let's go a step further and talk about some of the other taxes that they're talking about putting into place for corporations. One is the Social Security payroll tax. So again, you go back down to a small business owner. Maybe they're employing, who knows, 50 people, 30 people, whatever the number is. But let's assume they have a $100,000 monthly payroll. Well, you multiply that by 12, that gives them $1,200,000 that they're paying out in payroll. Well, the new payroll tax is stating, the Social Security payroll tax is stating that the corporations have to pay an additional 6.2% or doubling that payroll tax. Now, I have to tell you this because this is going to hit employees as well, because the employees also are going to get a doubling of that tax if it goes through the way they're proposing it. So that would be an additional 6.2% tax on the individual's payroll up to, I think the number is somewhere around 107,000 in income. So it's going to affect people on both sides, but let's talk again about the corporation. If you're a business owner and you're paying out an additional $74,000, do you think that business owner might think twice about hiring another employee, which kind of helps the economy, right? Well, I'm here to tell you they are going to think twice about that because $74,000 is literally another employee that you could hire. So it's got long-reaching ramifications when you're talking about the small business owners. Again, do we have a plan? And at the end of the day, it's all about planning to keep as much as you can keep legally following the tax codes. Well, it's something that we're really keen on when it comes to trying to preserve our clients' assets. I mean, everybody has their own circle of wealth. Some are bigger than others, but everybody wants it to grow, right? And at the end of the day, our job is to make it grow. And if we can't get that planning for you, then the odds of growing under a heavy tax environment is going to be more difficult. So that's why today is a good day. 2021 is a very good time to do additional tax planning. Yep. Because the other thing I was thinking about, Rocky, is, and I think we've talked about this with individuals before, and that is, many people have trained the CPA to lower your taxes as low as they can get it the year that you're in. And sometimes when you do that by deferring income out to later days is only deferring the problem to higher taxes. So the planning is the key. You need to be able to see the big picture of how these dollars work together in conjunction with other expenses to allow you to make sure that you're getting every dollar you can to keep it in your estate. I mean, again, I think most individuals do a good job of properly spending. And I don't know about you, but I would rather give my money to a charity than give it to the government. And we do, right? We give a lot out, and our clients give a lot out to charities. Which, by the way, kudos to you, because that's what helps our neighbors is being very charitable. So that being said, where are we at now, Rock?
I wanted to add one thing. I was doing a little calculation while you were presenting the proposed going back to the old taxes brackets, and that if you guys remember the $100,000 example I gave you up front of the single person, just a gross income of $100,000, that they would make pay about $18,000 in federal taxes, walking through those different brackets. And that's what their tax bill net tax bill would be about 18%. I did the same calculation while Dan was presenting based off of the proposed going back to the old tax structure, and that individual would end up paying on the same $100,000, $20,600. So it's a 2.6% increase on every dollar.
Yeah.
Okay, so it's significant. You know, do you want to keep that $2,600 in your pocket? And that would be double that for a married couple filing jointly.
Yeah.
It'd be just about double versus the single person. So it's, it's a lot to consider, a lot of information we presented to you, but I think we did a good job. And why don't, Dan, you go ahead and tell us more.
Well, at the end of the day, it really comes down to planning, right? And we have done a myriad of webinars. Many of them have different planning strategies in there. And so you can literally go to our YouTube site at Daniel Krug and Associates YouTube. And once you click into that, you're going to have a lot of videos to look at to really refresh your memory on different planning that we have. When you bring up some of them, we've talked about the different tax strategies, reallocating sectors for rebalancing. We've talked about making sure that if you're doing a Roth conversion, that you're maximizing the amount that you can convert long term. And these type strategies, the draw and let heal strategy, all of these are on our website, and you can go back and kind of review these. Or at the next time you sit down in a meeting, maybe we should touch base on different strategies to see where we are.
Right.
Again, I think when you look at 2021, this may be the last year that we can actually get where we want to go. So
just take advantage of it.
Absolutely. So, that kind of wraps it up. Again, give us a call if you need to give us a call, and we'll walk through anything that we can. If you need to have a meeting with us, just call Caitlin and she'll get you on the books for us.
Right. So just remember, there's no need to worry. You take care of your family, and we will take care of you. We're ready for the future, sitting down with you to build yours, looking forward into 2021 and 2022. So that's it from us. We'll say goodbye to everybody. Thank you for joining, and have a great day.
All right. Thank you.